second video on the work that we have to do for our cases and class exercises. So let me just go ahead and we'll begin. Now we're dealing with topic 3. For topic 3, you'll notice I didn't publish any exam questions. You can regard what you see here as a potential exam question, which means it is possible that I could give you a set of accounts and ask you to comment on things like liquidity, solvency, profitability, or efficiency. So very similar to what we've already done and covered in the class. So let's go ahead and have a look at this company and see what we have to do for this company. So as we mentioned in the class, what we're interested in is doing ratio analysis on financial statements. This is not an accountancy class. We're not worried about the construction of the financial statements. What we want to do is we want to be able to take the financial statements and extract information from them that tells us something about the company and what to understand from that. So task is, using the company financial statements for ABC given below, produce a ratio analysis of the company referring to the key characteristics of the firm. Okay, if you're not sure on how to do this, you can refer to the class notes that accompany the lecture slide on Moodle. So when you do perform calculations of this nature, always offer an interpretation beside them which are based on the figures. Okay, and use only the figures within the statements to draw the conclusions that you make. Okay, so it's what we would do in a sort of a larger exercise is we'd have these statements and ratios set against a benchmark, or we'd have a number of financial statements together. So all we really want to do is just to get you practiced and get you encourage your understanding on just conducting a simple ratio analysis. So let's take a quick look at what we've got here. So we have a balance sheet. We have the current assets, cash and cash equivalents, 500,000. Accounts receivables, if we remember what accounts receivables are, essentially it's money owed to us by clients. That's 750. Inventory, 1 million. Prepaid expenses, 50. So we're looking at a total of 2,300,000. That's our total current assets. Remember, we also have fixed assets. So when we have our fixed assets, we've got land and buildings, machinery, minus depreciation. So we take off depreciation because some of that machinery and some of those buildings would have lost value over time. And then we get a total value for our property, plant and equipment, which would be 3.5 million. Other assets then would be goodwill that was sort of came along with our company, so something that like a brand, for example. Intangible assets could be some intellectual property, and they total 1 million. So in total, 2,300 plus 2,300,000, 3,500,000 plus 1 million. That gives us total assets in the company of 6,800,000. Now our next protocol is to look at the income statement. So excuse me while I okay, so income statement for the company in 2022. We can see that we're looking at revenues of 10 million, where the cost of goods sold is 6 million. Our gross profit then would be 4 million. Now 4 million sounds like a nice chunk of change in terms of profit. Effectively 40% of our revenue is our gross profit. Now if we were to leave it at that, we'd feel like we're in a good financial position. But of course we have to take our operating expenses and other expenses out of that. So we're looking at our operating expenses. We're selling and admin expenses, 2.5 million. Depreciation, amortization, okay, that's another 100,000. Total operating expenses, 2,600. So 2,600 from 4 million, 2.6 million from 4 million gives us 1.4 million, and that's our operating income. That's what we're making after our operation. So we can see that the company itself seems to have a pretty healthy operating income. Now, the company's capital structure, therefore, will also needs to be brought into consideration. So you can imagine an all equity finance company would have an operating or a net income which would be equivalent to their operating income of 1.4 million. However, when we take into consideration the capital structure of the company and essentially the interest income and any other expense, we need to have a look at this. So other income and expenses. So we've got interest presumably from cash held elsewhere in the company, so that's 50,000. But our interest expense on the debt that we have is 100,000. Therefore, our total income and expenses equals to 50,000, and that gives us a net income before tax of 1.35 million. Okay, if we work out a tax figure, so our tax was given to us as 337,500. So our net income figure, and this is the figure that really is the bottom line. That's the figure that can be divided between retained earnings and dividends. If you could choose to pay it all out as dividends, you could choose to retain it all, or you could choose to do a split between the two of $1,012,500. So let's go on to the next part. And now we take a quick look at the cash flow statements for the company. So let's just, excuse me while I move it across here. Okay, cash flow statement. Remember, on a cash flow statement there are three main activities: operating, investment, and financing activities. And we see if we have our net income, we add back in the depreciation and amortization. For those of you who still don't really know why we add back in depreciation and amortization, we do this because it's an expense that never actually leaves as cash. Okay, so that's an expense that never actually goes. Okay, increase in accounts receivable. So again, we make some revenue, but we don't actually get the cash. So that comes out as 150 minus figure. Increase in inventory, again these are an increase in current assets, but again these have to be purchased. Increase in prepaid expenses, again money flowing out of the company. Increase in accounts payable, so that's money that we don't actually, so services or goods that we purchase we haven't actually paid for, and that comes in as a positive cash flow because we haven't actually paid for it. And an increase in accrued expenses in the same vein that appears as a positive cash flow. So we've got a net cash flow from the operating activities of 1.822,500. So 1.8 million roughly. Okay, so that's pretty good. That looks like a decent flow of cash from those operating expenses. We can see that we use some of that cash to purchase some property, plant and equipment, so that features as a negative on the investing activities. And we brought in some cash. We capitalized our company somehow by bringing in some cash, so we sold some stock at 500,000 and we issued some bonds, issued some long-term debt at 1 million. Okay, we repaid some of that debt and we paid off our interest, and that gave us a net cash from the financing activities of 1.15 million. So the increase in cash and cash equivalents amounted to 2.472, and we add all those up together, 2.472,500. We already had cash at 27,500. That leaves us with a cash position of 2.5 million, which looks fairly solid.